A hidden crisis is about to make silver unobtainable at any price. Have you ever truly considered the tangible value of the currency resting in your wallet or the digital numbers sitting in your bank account? We operate on a collective faith in a system of paper and promises, a system that is showing profound and undeniable signs of strain. What if I told you that a critical pillar of both our industrial and historical monetary systems is facing a covert supply crisis? A shortage engineered not by market forces alone, but by a confluence of military demand and a fragile global supply chain. This isn't a theoretical exercise. It is a developing reality that points to a fundamental flaw in our perception of wealth and the very definition of money itself. The story involves advanced weaponry, a common industrial chemical, and the quiet panic of refineries, revealing a truth that could redefine your financial future. The core problem we face is the systematic and accelerating debasement of our currency. For decades, we have witnessed a departure from sound money principles, replaced by a reliance on fiat currency, backed by nothing more than government decree and public confidence. This has allowed for unprecedented levels of spending and debt accumulation. Consider recent legislative actions adding trillions of dollars to national spending, far exceeding annual revenue. This isn't just bookkeeping. It's a direct injection of new currency into the system, diluting the value of every dollar already in existence. This creates an economic environment where saving money becomes a losing proposition, as its purchasing power is relentlessly eroded by inflation, a hidden tax on every citizen. This is the foundational crisis that is driving a silent but significant migration of capital away from traditional financial instruments. This relentless currency printing presents a seemingly inescapable trap. Central banks are caught between the need to fund ever-expanding government obligations and the risk of triggering runaway hyperinflation. To combat rising prices, they would need to implement deflationary policies, which would mean drastically cutting spending and raising interest rates. However, this would likely trigger a severe recession and make servicing the colossal national debt an impossibility. This is the crux of the issue. The system is predicated on perpetual expansion and inflation. The opportunity for those who recognize this predicament lies in seeking refuge in assets that cannot be printed into oblivion. Hard assets with intrinsic value and finite supply offer a store of wealth that operates outside the direct control of central banks and governmental fiscal policy, serving as a financial lifeboat in an ocean of depreciating currency. The primary catalyst for the impending disruption in the precious metals market is a startling and largely unreported event, a perfect storm brewing at the heart of the silver refining industry. A source deep within the defense sector has revealed a critical development. A major defense contractor is currently engaged in the mass production of advanced missile systems. This is not just any military project. These specific missiles require silver of exceptional purity, specifically 4/9 or even 5/9 fine silver, for their sophisticated components. This sudden, massive, and non-negotiable demand from the military-industrial complex has placed an enormous and unanticipated strain on the specialized refineries capable of producing silver to such an exacting standard, diverting a significant portion of refining capacity towards a single, high-priority consumer. Simultaneously, a second, parallel pressure point emerged from the retail side of the market. As the nominal price of silver recently surged, approaching psychologically significant levels, it triggered a massive wave of selling from the public. Individuals who had been holding silver for years saw an opportunity to realize gains and flooded the market with everything from sterling silverware to 90% constitutional silver coins. This deluge of scrap and alloyed silver overwhelmed the intake capacity of refineries, which were already straining to meet industrial and investor demand. The critical consequence was a massive spike in the consumption of nitric acid, an essential chemical agent required to dissolve base metals like copper and purify the silver. This dual shock, a surge in industrial demand for pure silver and a surge in retail supply of alloyed silver, created an unprecedented drain on a critical and finite industrial resource. The innovation, or rather the forced adaptation, that has emerged from this crisis is the rise of fractional and divisible forms of silver, designed not for speculation but for utility. For years, the concept of using precious metals for small-scale barter and trade was dismissed by many as a fringe idea. However, as the flaws in the mainstream financial system become more apparent, the logic of holding real money in a usable form is gaining widespread acceptance. Products like small 1/10-ounce silver bits represent a crucial innovation. They are not intended to compete with large investment bars, but to fill a different, more practical niche. They are designed to be a means of exchange in a future where the digital payment infrastructure may be unreliable or the fiat currency has lost significant value. This is a shift from viewing silver as an investment to be sold back into dollars, to viewing it as a parallel currency to be spent directly on goods and services. The tipping point in this developing crisis is the moment the supply chain choke point becomes public knowledge and its effects become undeniable. We are witnessing the early stages of this right now. Refineries, facing a critical shortage of nitric acid and overwhelmed with difficult-to-process material, have begun to selectively halt their purchasing. They have started to refuse 90% silver and other alloys that require extensive chemical processing, prioritizing the easier task of melting and recasting pure 0.999 silver. This creates a dangerous bifurcation in the market. The official spot price, derived from paper futures contracts, may suggest one value, but the physical reality for those trying to sell common forms of silver is entirely different. The market is beginning to price in the difficulty and cost of refining, a factor completely ignored by the paper markets. This phenomenon is already visible to discerning observers. A look at online marketplaces like eBay reveals a startling disconnect between the paper price and the price for physical delivery. For example, a monster box of silver eagles might be available for a price equating to $53 per coin, but with a delivery date months in the future. For immediate delivery of the exact same product, the price might jump to over $70 per coin. This is not a normal market premium. This is the market screaming that there is a severe shortage of physical deliverable metal right now. The tipping point will be reached when this reality can no longer be masked by futures market machinations, and the public realizes that possessing a paper claim to silver is not the same as holding the physical metal in your hand. The price will become irrelevant if the product is simply unobtainable. The immediate impact of this refining bottleneck is a dramatic tightening of the available supply of newly minted silver products. If refineries cannot process scrap and alloyed silver efficiently, then the pool of raw material available to mints and manufacturers shrinks considerably. This directly affects the production of popular investment products like rounds and bars, leading to inventory shortages and extended delivery times. We are already seeing evidence of this, with reports of it becoming increasingly difficult to source certain sovereign coins like American eagles and Canadian maples. This supply squeeze has a compounding effect. As availability dwindles, the premiums over the spot price for the remaining physical products will inevitably escalate, further widening the chasm between the paper price and the real-world cost of acquiring tangible silver. The aftermath of this supply shock will be a fundamental reevaluation of what constitutes true value. As the crisis deepens, the focus will shift from the speculative dollar-denominated price of silver to its intrinsic utility. The ultimate question will no longer be, how many dollars can I sell my silver for? But rather, what can I acquire with my silver? In a scenario of significant currency devaluation or economic instability, the ability to trade a small, universally recognized unit of value for essential goods like food and fuel becomes paramount. This is where the foresight of acquiring divisible forms of silver will be profoundly validated. The person holding a 100-ounce bar may struggle to buy a loaf of bread, while the person with 1/10-ounce pieces is perfectly equipped for a new economic reality. This shift will also expose the fallacy of a dollar-based exit strategy. Many who enter the precious metals market do so with the intention of making money, which they define as accumulating more dollars. However, this strategy is fatally flawed in a hyperinflationary environment. Selling your silver for a large sum of rapidly depreciating dollars is a Pyrrhic victory. The dollars you receive today may lose a significant portion of their purchasing power by tomorrow. The true exit strategy, therefore, is not to sell your hard assets for fiat currency, but to use them as a bridge, a store of wealth to be preserved or to be traded directly for other tangible assets, be it land, equipment, or essential supplies. The goal is not to get rich in dollars, but to preserve wealth regardless of what happens to the dollar. A fascinating sociological shift is occurring alongside these market mechanics. A new demographic is entering the precious metals space, one that is younger and more diverse than the traditional investor profile. We are witnessing an influx of younger men and women who are not necessarily driven by conservative or libertarian ideologies, but by a pragmatic distrust of the establishment and a clear-eyed view of the economic landscape. They see the writing on the wall regarding government debt and currency debasement. This new wave of buyers understands the concept of sound money intuitively and is less concerned with market speculation and more focused on wealth preservation and preparedness. This is a grassroots movement, a quiet revolution against a financial system they perceive as fundamentally unstable and unfair. This trend is indicative of a broader awakening. People from all walks of life are starting to question the narratives they have been fed about money and the economy. Even those who might politically align with the establishment are seeking alternatives to a system they feel is failing them. The idea that silver and gold are a hedge against systemic risk is crossing ideological divides. It's a powerful signal when individuals who are deeply embedded in the mainstream begin to adopt strategies previously associated with financial contrarians. This suggests that the underlying problems in our economy are becoming so obvious and acute that they can no longer be ignored or explained away by political rhetoric. The desire for financial sovereignty is becoming a universal, rather than a niche concern. The long-term takeaway from this unfolding situation is the reaffirmation of an ancient financial principle: tangible assets hold enduring value. For thousands of years, silver and gold have served as money because they possess the essential characteristics of a stable medium of exchange. They are durable, divisible, portable, have intrinsic value, and most importantly, have a finite supply that cannot be arbitrarily increased by a government. The current crisis is a stark reminder of why humanity turned to these metals in the first place. When systems built on trust and promises begin to crumble, society instinctively reverts to what is real and tangible. The lesson here is that true wealth is not an abstract number on a screen, but a physical asset you can hold in your hand. Furthermore, this episode serves as a critical lesson in the importance of understanding supply chains. We live in a highly complex, interconnected world where the production of even the simplest goods depends on a long and often fragile chain of inputs. The silver market's dependence on nitric acid is a perfect microcosm of this reality. A shortage of a single, seemingly obscure industrial chemical can bring a multi-billion-dollar global industry to its knees. This teaches us that we must look beyond the surface-level price of an asset and consider the physical realities of its production and availability. The most significant risks are often hidden one or two layers deep in the supply chain, and it is the recognition of these vulnerabilities that separates the prepared investor from the rest of the market. The concept of divisibility in assets is emerging as a paramount strategic consideration. While large bars of gold and silver are efficient for storing significant wealth, they are impractical for everyday transactions. The growing interest in fractional silver underscores a shift in mindset from simply hoarding wealth to preparing for a scenario where that wealth must be utilized in small increments. This is not about doomsday prepping, it is about practical financial insurance. Having the ability to make small-scale purchases with a stable form of money provides a level of resilience and independence that is impossible to achieve with large, indivisible assets or a purely digital financial footprint. The future of personal finance may involve a tiered approach, with large assets for wealth preservation and smaller, divisible assets for liquidity and transactional capability. Ultimately, the most profound lesson is about legacy and intergenerational wealth. Many of the most astute individuals acquiring precious metals today are not doing so with the intention of selling them within their lifetime. Their primary goal is to create a store of wealth that can be passed down to their children and grandchildren, ensuring their family's financial security regardless of the economic turmoil that may lie ahead. This requires educating the next generation about the nature of real money and the history of finance, so they don't mistakenly trade a timeless asset for a fleeting currency. It is a strategy focused on the long-term preservation of purchasing power, a stark contrast to the short-term speculative mindset that dominates modern financial markets. True wealth is not what you spend, but what you successfully pass on. The debate over the utility of silver in a crisis often encounters skepticism, with critics arguing that in a real collapse, essentials like food, water, and ammunition would be the only things of value. This argument, however, misses a crucial point about the function of money. While those items are indeed vital, they are poor mediums of exchange. Barter is incredibly inefficient due to the double coincidence of wants. You must find someone who has what you need and who also wants what you have. Trying to trade chickens for gasoline or pants for medicine is a logistical nightmare. Money solves this problem. Silver and gold serve as universal intermediaries because they are durable, universally desired, and don't spoil. They are the catalyst that allows a complex system of trade to function even when the official currency has failed. The inherent value of precious metals is what underpins their monetary role. Unlike bananas that spoil or jeans that only fit a certain person, silver and gold have a persistent utility. Silver, in particular, has thousands of industrial applications in everything from electronics to solar panels to military hardware, as we have seen. This industrial demand creates a fundamental floor for its value. Because it is so useful, it is always desired. This dual nature as both an industrial commodity and a monetary asset is what gives it its unique resilience. It is not just a shiny rock. It is a critical component of our modern world that also happens to have a 5,000-year history as a trusted medium of exchange. This is why, in a crisis, it becomes the default asset for facilitating trade when faith in paper currency evaporates. Let's delve deeper into the absurdity of the current pricing mechanism for silver. The spot price that is broadcast on financial news networks is not determined by the physical buying and selling of the metal itself. Instead, it is derived from the trading of futures contracts on exchanges like the COMEX. The shocking reality is that for every 1 ounce of actual physical silver that exists and is available for delivery, there are hundreds of paper contracts claiming ownership of it. This creates a highly leveraged fractional reserve system for silver that is susceptible to massive manipulation. A small number of large players can sell enormous volumes of paper contracts to suppress the price, creating a value that is completely detached from the real-world supply and demand dynamics of the physical metal. This blatant manipulation was starkly illustrated during a brief period when the futures market for oil collapsed, resulting in a negative price per barrel. The paper market was telling you that sellers would have to pay you to take their oil. Of course, you could not actually acquire physical oil under these terms. It was a dislocation caused by the mechanics of the futures market. A similar event is not only possible, but likely in the silver market. A day may come when the spot price is quoted at one number, but no one on earth is willing to sell you an ounce of physical silver for that price. The physical market will simply detach from the paper market, and those holding paper claims will be left with nothing, while those holding the metal will possess the real asset. This brings us back to the crucial question of your personal financial strategy. If you accept the premise that the official spot price is a manipulated fiction and that the fiat currency is in a state of terminal decline, then your objectives must change. The goal is no longer to use silver to accumulate more hyperinflating dollars. The intelligent strategy is to use hard assets for significant life purchases, using gold to acquire a piece of land or a business, for example. For daily economic life, the strategy shifts to using smaller denominations of silver to transact directly for goods and services. This is how you exit the failing currency system, not by cashing out, but by transitioning to a more stable and honest form of money for your significant transactions and daily needs. The overwhelming demand for divisible silver is no longer a theoretical projection. It is a market reality. We are witnessing weekly sales volumes in the millions of dollars, with a significant portion of that demand being for small fractional pieces. One anecdote tells of a single customer purchasing $100,000 worth of 1/10 ounce silver bits in a single transaction. This is not the behavior of a speculator looking for a quick profit. This is the action of someone who has deeply considered the future of the financial system and is taking concrete steps to prepare for it. The fact that the production of these small denomination pieces can barely keep up with retail demand, leaving none for the wholesale dealer network, is a powerful indicator of where the most informed capital is flowing. The market for accessories and support systems around these new forms of money is also a telling economic indicator. The creation and commercial success of products designed specifically to store, carry, and dispense fractional silver pieces demonstrate the maturation of this new ecosystem. When an entire cottage industry springs up to support a core product, it signals that the product is not a passing fad, but is meeting a genuine and growing market need. The fact that an entrepreneur can generate six-figure revenues in a matter of months, simply by creating a convenient dispenser for silver bits, speaks volumes about the conviction and commitment of the people in this community. They are not just buying a commodity, they are adopting a new financial technology and integrating it into their lives. A direct comparison between traditional 90% silver coinage, often called junk silver, and modern, pure fractional silver reveals a clear winner for practical use in the modern world. While junk silver dimes and quarters served a purpose for generations, they have significant drawbacks today. They are only 90% pure, the general public does not recognize them as silver, and crucially, even refineries are beginning to reject them due to the chemical intensity of the refining process. A modern silver bit, by contrast, is 0.999 pure silver. It is clearly marked with its content and weight, and its value is immediately recognizable to almost anyone. The math is also far simpler. A tenth of an ounce is an easy unit to calculate with, unlike the convoluted calculation required to determine the silver content of a pre-1965 dime. Imagine a scenario where you wish to use silver for a small transaction, perhaps leaving a tip for a waitress. If you leave a 1964 silver dime, there is a high probability she will not recognize its value, and may even discard it as foreign currency. Its monetary value is hidden knowledge, accessible only to a small segment of the population. However, if you leave a 1/10 ounce silver piece, its nature as a precious metal is self-evident. The inscription of silver and its weight communicates its value instantly, without requiring specialized knowledge. In a world where you may need to transact with people who have no prior experience with sound money, clarity and universal recognition are essential. This is what transforms a piece of metal from a collectible into a functional monetary tool. The confluence of factors we have discussed paints a precarious picture for the future availability of silver. The immense industrial demand, driven not only by defense spending, but also by green energy initiatives and the construction of liquid-cooled data centers, is on a collision course with a growing wave of investment demand from a public losing faith in traditional finance. This is all happening against the backdrop of a critical bottleneck in the refining process caused by the nitric acid shortage. This isn't a temporary glitch. It's a structural limitation on how quickly the market can respond to rising demand by bringing new supply online through recycling. It effectively places a governor on the entire system, meaning that even a modest increase in demand from here could be enough to wipe out all available inventory. The future is likely to be characterized by increasing volatility and divergence. The paper price of silver may continue its erratic movements, influenced by derivatives traders and macroeconomic news. However, the physical price, the actual cost to acquire and take delivery of the metal, will likely continue its steady march upward, with premiums expanding and availability becoming more sporadic. We may see a future where major dealers are frequently out of stock of many popular products, and acquiring silver will require patience and persistence. The concept of dollar-cost averaging will remain a prudent strategy, but the primary challenge will shift from timing the price to simply securing the physical product at any price. The true measure of the market will not be the COMEX price, but the line of people waiting outside the coin shop. Predicting the exact timeline for these events is impossible, but the trajectory is clear. The massive expansion of the money supply and government debt is not sustainable. A financial reckoning of some kind is inevitable, though its form is yet to be determined. It could be a hyperinflationary collapse, a deep deflationary depression, or a period of protracted stagflation. In any of these scenarios, the ownership of tangible assets, particularly monetary metals with no counterparty risk, will be a crucial element of financial survival and prosperity. The current hidden refinery shortage is a canary in the coal mine, a warning signal that the deep structural problems in our financial and industrial systems are beginning to manifest in the physical world. Therefore, the ultimate takeaway is not one of fear, but of empowerment. Understanding these dynamics provides a roadmap for navigating the uncertain economic terrain ahead. It calls for a paradigm shift in how we think about money, wealth, and security. The strategy is to build a resilient financial position that is not solely dependent on the stability of a single currency or the solvency of a particular government. It means diversifying into real, tangible assets that have stood the test of time. It means valuing utility and durability over speculation. By recognizing the fragility of the current system and taking prudent steps to insulate yourself from it, you are not merely preparing for a crisis. You are building a foundation of enduring wealth for yourself and for the generations that will follow.